All right, this is being recorded, guys. One thing I say at the beginning of every single webinar I have is watch this again relatively soon afterwards, because if you're new to options or even new to the way that I teach options, you may lose some of the nuances the first time through. The second time through, I think you'll be clear of concept anyway. So let me go over a couple other things that I got to get out of the way real quick. My name is Wilkinson. Some of you guys may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal for my commentary on everything from economic to geopolitical and market analysis. I started trading in college with some money I had earned, and then after graduating with a finance degree, I moved up to Chicago and started working on the floor of the Chicago Board of Trade. And in that time, I've traded everything from stocks, financial futures, commodity futures, currencies, and options on all these products, just about in all market conditions. Also, we got to go over the disclaimer. Says any opinions, news, research, and analysis or other information contained in this webinar should not constitute investment advice and should only be construed as general commentary. And please remember that past performance of any trading system or methodology is not necessarily indicative of future results. And you can follow me on Twitter at Wolfman's blog and our parent company at ProTrader Strat. It's coming into earnings season, so follow me there because I usually tweet out what my earnings trades are going to be. So you got to be watching that because the daily market commentaries are done in the morning and I won't be able to get to it by that time. So this is on the Long Strangle. We did the Long Straddle last week. The straddles where we're picking two strikes at the same location. With this Long Straddle or Strangle, we're going to be picking about the 30-ish delta. And the reason why I say the 30-ish delta is because you never get an exact number. The higher, we're probably going to be shooting closer to about the 32, 35 area. But something in the 30s is what we're looking for the Long Strangle, to have our probabilities in line with what we're trying to do here. All right, so the essentials to success here, you guys. Slides still not changing? Are the slides changing for anybody else? JQ says the slides are not changing. Can you see this slide here? Robert, you just said yes. Is that a yes that the slides are not changing, or yes, the slides are changing? Because I should be on essentials to success here. They are changing. Okay, picking the right environment is the last slide. Perfect. All right, so picking the right environment, you guys, when we're doing long strategies, whenever we're paying a debit, sometimes I get a little long-winded, JQ, and it looks like we're staying on the same slide for a long time, I guess, maybe. Anyway, but the right environment here, when we want to buy option strategies, we want really low implied volatility percent for any one of these underlyings, okay? Whatever underlying you're trying to pick. If it's a stock, we want the IV percent to be below 50. And if it's an ETF, we want that environment to be below a 30. Now, right now, in this environment we're in, it's going to be very difficult to find stocks that fit this particular parameter. There are a few out there, but as you know, with the markets the way it's been the last couple of weeks, we've gotten some really big volatility pumped into the market. So we're going to have to be a little bit more selective when we're doing the long strangles than we've had to be in the past, that's for sure. It seems like in the past you've been able to throw darts at a watch list. Now it's going to be, you need a surgical knife to find them. All right, so picking the right underlying. So when we're talking about, let me go over this picking the right environment real quick again, because I want to make sure everybody is clear of this. So when we're talking about IV percent, what we're talking about here is every underlying, whether it's Micron Technology, Apache or any of that, they all have their own implied volatility. Utilities will usually have a really low implied volatility versus something that is like a tech stock like NVIDIA or Microsoft. Microsoft's normally in the 35s, where you might see a utility stock or something like that, or Kellogg, something like that, normally in the 20s or something. So we have to discern whether or not 35 for Microsoft is high for itself. And we want something that is really low. We want something below an IV percent of 50. And as you can see here, just by looking at this chart, you can tell it's at the upper band, probably in the upper 90% here, right? But the way to figure this out is we have a numerator and a denominator. and we take the sum of the numerator and divide it by the sum in the denominator. So what do we put in the numerator, which is on the upper part of the fraction? We take where the current implied volatility is right now, which is 35. So we take 35 minus the low, which is 13. So 35 minus 13 gives us, sorry, I'm getting blown up on my phone. I'm going to have to turn it off. It's going to be 22. So we take that 22 and divide it by the high minus the low. So the high minus the low is, the high is 38 minus the low, which is, what do we say, 13? So 25. So 22 divided by 25, you know, it's 88%. I said 90% ballparking, but that's pretty close. So that would not fit this being a low IV percent, because when you come up with a percent, right, you multiply it by 100, so it's an 88%. So that's too high. We want something below an IV percent of 50. So we would look at something like maybe Target, and we can see Target is trading right now at around 27. Implied volatility for Target is 27. The low that we've seen in the last 52 weeks is, what is that, 20. So 27 minus 20, we have 7 in the numerator, and divide that by the high minus the low, which is 47 minus 20. 47 minus 20. So we have 7 divided by 7 divided by 27, right? 7 divided by 27 is a 25%. So that's pretty cool. You know, I'm rounding it off, obviously, but it's an IV percent of 25, 26-ish. This says 27. I'd go with that because their exact math is not my ballparking. But that would fit the rule, something like for Target. So we want something with low implied volatility percent, like I have in my watch list, of below 50 for a stock and below 30 for an ETF, which an ETF below 30 is going to be very difficult to find. The only thing is XLV. Okay, but normally speaking, that's the rule of thumb for picking the right environment. Now, picking the right strikes, like I said, we're going to be looking at that, or sorry, picking the right underlying. We're going to be picking something that has a tight bid ask. And this goes with just about, these first couple are, you know, all of these steps are something we can use for every single strategy I teach. And then you just check them off the list. So the right underlying is when we go to the monthly that is nearest to the expiration. Obviously, October is the nearest monthly to expiration, but it's not the spot month. It's the 29 day is where most people are going to be trading. So somewhere around that 30-ish days to expiration is the one we're going to look at, because that has the most participation for any particular underlying, almost generally, almost most of the time, I would say. So for instance, any stock under $100, we're going to make it 10 cents wide. It needs to be at least 10 cents wide for the bid ask. As you can see, Target is not fitting that rule right now. Normally during day trading hours, that will fit the rule, but we want to look to something that has a bid offer that's closer than 10 cents wide. Again, Delta Airlines is not going to fit that rule right now, but during the day sessions, just check these monthlies that are closest to expiration, 10 cents wide for a stock under $100. If it's a stock over $100, just move this decimal 3 ticks to the left. We've got 23 cents. These should be within 23 cents on the monthlies, okay? So make sure that those 2 rules are fulfilled before moving on. The reason why is if you get into a stock that is really illiquid, meaning there's not a lot of participation in here, there's not a lot of volume and open interest, the bid ask is going to get really wide because there's only a few people in there making the markets, maybe even one in some instances, and that could even be an algo, I suppose. But there's not a lot of people in there trading this, so, you know, there's not a whole lot of free market price discovery. There's one person making a market and making you come to him. All right, so we want to stay away from that pitfall. Stock under $100 needs to be at least 10 cents or better between the bid ask, and on a stock over $100, 3 ticks to the left, that's how wide the bid ask should be. If it's a $1,000 stock, 3 ticks to the left, that's $1 wide, right? So picking the right environment, last slide, I will try to reload. Okay, you're good now? All right. That doesn't happen often. Gremlins. So JQ's fixed up. We're back on track. All right, so follow that rule for picking the right underlying. Now, after that, then we need to figure out what's our duration. What should we be looking for in that option montage I just showed you? There are a lot of choices going on here, right? You know, when you're trying to figure out what I'm doing a straddle, where should I be placing my trade? Well, we're buying it. And there's one thing that happens when we're buying options is there's this component called theta, and it's the thief in the night that comes to steal your premiums, and it decays, you know, at different rates depending on the strikes. But we're going to be picking these ones that are relatively close to the at the monies, and you can see that those are the ones that are going to start decaying the most, right? 7 cents is right there close. Further away you get, they don't decay as much, but the closer to the at the money, we have to start worrying about this theta decay. And it also picks up the closer we get to expiration. As you can see, theta on the last couple of days, look how fast theta is creeping up back here, or closer to expiration. Whereas the further out we go, we can see that theta component. Let's try and go a little bit fewer. You can see the theta component is much less on these ones that are close to at the money. You can see it's a few pennies a day less, which, you know, is going to make a big difference. So in that, picking the right duration, if we are buying and we want to limit that theta decay, we need to go further out in time. Now, where is the sweet spot for this? You know, if you're, you know, you could say you could go all the way out to these January, and yeah, you're going to have very little theta decay. But I'm never planning on being in this trade for that long. So why would I want to buy, pay for all this premium? Okay. So the wheelhouse I found is just outside of around 50 days or more. So 50 to, you know, 100 days is probably the right wheelhouse. We don't have any Ds in here. That would probably be the perfect scenario for this one. But we definitely want to get outside of 50 days to expiration, because that's where theta really starts picking up. So inside of that 35 days, that's what we were talking about. This is where it really starts picking up. So that's why we would want to go out in time further to where that January is out here. The December is going to be somewhere right in here, which would be the perfect strike. If we don't get it, we just have to move on and out. All right. So picking the right strikes, that's that 30-ish delta I was talking about, because it's about a half a standard deviation away. And last minute, I pulled up this chart. It's not on the slides, but you can see a half a standard deviation away from where the underlying is currently trading is, if you add up all of these percentages together, you're going to get around 32%, okay, 33 or something like that percent, and especially if you continue to add up all these tiny decimals. So that's why we're looking for a half a standard deviation. Also, with that being said, a half standard deviation move is right around that 30-ish delta that I talked about. And when we look at the option montage, some of the things that delta tells us is the probability of being in the money at expiration by 1 penny, like any of these strikes, okay? So the 230 strike says that in 29 days at expiration, there's a 47% probability that this underlying will finish at $230.01. Okay, so that would mean these finish in the money by 1 penny. Same over here. It's saying the 220 strike in the next 29 days has a 25% chance of finishing $219.99 on that last day. Okay, there's that. That's the probability. That is why we want to have a high probability strategy in here, where we have at least a 30% probability of finishing 1 penny in the money at expiration, because during the life of that option contract, it's a little floor trader hack. It's 2 times the delta is the probability that during that time, it will just be kissed. Now, delta tells you what it's going to finish, the probability of finishing in the money by 1 penny. The trader hack is during the next 92 days. It says that the XYZ or Costco has a 34% probability of finishing in the money in 92 days, or 2 times that is the probability of being touched. So a 68% chance in the next 90 days that Costco will trade up and at least trade the 240 handle one time, okay? Or down here to the downside, that in the next 92 days, the 223 strike has a, what is that? A 76% probability of being touched, or this one has a 68% probability of being kissed on the downside, meaning it just comes down and trades 220 one time at least before moving away. So that's why we want to pick those strategies, because anytime you have a 60% chance or better of having it come to fruition is pretty good probabilities. And the probabilities are even slightly better because it could go in either direction at any given time. Because remember, we're going to be buying this 34 delta and buying this 220 strike, which is a 34 delta. So that we would be buying those two on this strangle in order to create this strategy, because that falls pretty much in line with what we're talking about here on my rules. So both of those added together is where we would be shooting for, all right? And then we don't have that theta decay component. We also give ourselves a lot of time to be right, okay, by doing this. You're paying a little bit more, but you're limiting your theta decay and you're giving yourself a lot of time to be right. Now, I've talked about a couple of things here. Remember, we initially started out with the environment, and now we're talking about strikes. Now, there's something peculiar that happens when volatility is where it is right now. And this is why it's super important to understand why we are trying to pick low volatility strategies. And I've come up with a situation where I'm trying to compare apples to apples. You can't really do that very easily with options, but I've come pretty close. So what I want to look at is this Nike example. And this is an older example of Nike. But what we can look at here is Nike. I'm doing this strangle according to my rules and picking the 34-ish deltas, pick the 57.5 and the 62.5 calls, or 57.5 puts and the 62.5 calls, paying 93 cents for this strategy. Now, when volatility starts increasing, we can see that the volatility increases bias by 5%. You've seen me use this before, that purple line, when we set up this strategy right here. If the market didn't move at all and volatility just expanded, the days didn't go by, volatility was the only thing that really went up. And let's say Nike went from implied volatility of, I think it was around 5% here, and we increased it by 5%. You can see that immediately, without even the underlying moving from 59.77, really, it went from 59.77 to 59, or 59.75 to 59.77 while I was doing these screenshots. But you can see just the increase in volatility puts you into profitability. This purple line shows you when you're going into profitability on these type of strategies when you're building out the synthetics. Now let's look at a stock that has a similar pricing where we're right around 60 or as close as we can get to 60. And we would pick those same strike locations, all right? In this original one, we did the 57.5s and the 62.5s. Well, let's look at Lululemon, which has a higher implied volatility, 45. The IV percent in Lulu in this example is 45%. The IV percent in the Nike was 5% when we first set it up. Now, if we pick Lululemon at those same strikes, the 57.5 and the 62.5, with that big difference in just volatility, I mean, we can say the price is a little bit different, but can we say that, you know, we're off by $1 here, and that's not that big of a deal? It shouldn't make that big of a difference. Our payment, our cost for this strangle at those same strike locations is $4.75 for Lulu, as opposed to 95 cents for Nike. That's because you're paying for all of that volatility. And if we were going to look at just, all right, well, where would the strike locations have to be if I just wanted to pay 95 cents for the Lululemon strangle? Look how wide they would be, all the way down to the 50 puts and the 72.5 calls on the upside to pay less than $1 for Lulu. So that's why it's extremely important. If you are thinking you want to do a long strangle, you're expecting something to have an outpaced move, bigger than what the market expects, all right? Know that you need to have really low implied volatility percent or really low implied volatility as well for this strangle to work out. Because if we were just saying this was a Nike had just expanded to 45 implied volatility percent, you would see very similar strike locations for that Nike versus a implied volatility percent of just 5. Okay. So when we're comparing these, that's why we need to have that really low implied volatility when we're setting this up. And finally, knowing your exit strategy before entering a trade. Remember, especially with a strangle, it's going to be a lower probability strategy. I've tried to set it up so we've increased our probabilities of success. But when we're trying to get out of this, I usually look to exit this strategy when it's doubled in value. That's my first thing that I do to write down. And one thing I say is keep mechanical with this. Always have these lists of your checkoff list on a spiral notebook, all right? So when you're thinking about entering a strategy, go through this checklist. When you've decided to enter this strategy, write down why you got into it, what made you have your market assumption, and what the environment was in and around it. Write down the implied volatility percent, where you paid for it, your strike locations, all of that stuff. And then write down when I'm going to exit. For that Nike trade, I said, I got in it for 93 cents. I'd be looking to get out at about $1.90 or something like that when it's doubled, $1.86. All right. So I would write that down, looking to get out at $1.86. But what happens if we get this big move right away, like 2 days afterwards? We need to start really reevaluating, because the probabilities are kind of against us for this long strangle to finish in the money at expiration anyway and get that full bang for your buck. But when we start getting this big outpaced move, we need to start considering taking less profits earlier if we start seeing that big move, like we saw in the S&Ps last week, where it seemed like everything was hunky-dory, and then all of a sudden we got this big, huge move, and then a snap back a couple days later, right? Well, we don't want to get that snap back. If in 10 days we're at a 20% increase in profit from that $1 to $1.20, I might really consider getting out of this for a 20-cent profit. 15 days in it, a 30% profit, definitely consider it. So inside of 20, so like 13 days in, you're at a 30% profit. I would seriously consider getting out of this, all right? Because you're beating the probabilities faster than what would be expected. So follow these. If I'm in this I maybe should have less than days in the trade, less than 10 days in the trade, less than 15 days in the trade, and you're at this increase in profit, then seriously consider getting out. It doesn't always have to be that double that you got on that trade. Does that make sense? All right, and these max profits, max loss, break evens, all of that stuff is really taking into consideration you've held this all the way to expiration. You rode it right into the sunset to the last day. I don't do that, obviously, with my rules of getting out at a % increase of profit. I don't want to get into that whole last day where you're messing around with the big dogs that are running billion-dollar funds trying to get their settlement, all right? Our small accounts are not going to be able to push the markets enough to get to our settlement. Get out before those big boys start playing. All right. Don't want to be in the sandbox with them. All right. So our max profit is unlimited because it can go in either direction to infinity and beyond, right? In the next 90 days. Not likely, but you have to take that into consideration. Max profit to the upside is completely unlimited. To the downside, it's to zero. It's going to feel like unlimited though. Max loss is always the premium paid in a debit spread. Anytime you pay a debit for a strategy, you know that that is the limit to your losses, okay? And then our break even, and this is especially important because this really only comes into play at that expiration date, all right, is when the underlying price is at the long call strike plus the premium paid, so to the upside. In the Nike example, we were doing a $60 or what was it? I don't remember what my example was now. 52.5 and something else, right? So our break evens on that. Let's just go back real quick to that Nike. Sorry, guys. One more. On this Nike example, yeah, we did 57.5. So to the downside, we subtracted $1. So the 57.5 subtract $1, 62.5 at expiration. It needs to be lower by 1 penny to be profitable at expiration. And to the upside, it needs to be higher by that dollar. So the 57.5 to the downside, 56.5, and to the upside, we did 62.5 to the 63.5 because that dollar added in to the upside. All right, subtract to the downside, add to the upside that $1, and that's on expiration. So if this market, like I said, does anything different, like volatility expands quickly, that break even is going to be coming into fruition much quicker. Like one day, you might even see that profitability right away. So that those profit and losses that I showed you there are really based on the expiration, at expiration, where you've gotten all the theta decay and everything else coming out of it, right? You can see your profit happen much quicker, well before that, with volatility expansion or the market moving, okay? Market moving relatively quickly after putting on this strategy, because this is taking into account that theta decay. All right, so let's pull up the trading platform. You guys can throw out some examples for me and say, some stocks you want me to look at, and we'll take a look at them. Might as well go through. Costco's a little bit high and doesn't have that D's component. I don't like paying that much for this type of strategy. So let's take a look at Target. Target doesn't have them either. So let's just look at Target anyway. Look for that 30-ish delta. We could do a pick 'em here. I'd probably go closer to the market because I want this strategy to come in quicker. So buy that one and buy the other 36 delta as well. So on this, we're paying $5. We'll look at it on the Analyze tab. And you can see here, let me get rid of this one. So this is our break even. So we've got the 80 puts right here, and we paid $5.50 on it. So to the downside, $5.50 at expiration would be our break even. In the same situation to the upside, add in $5.50 to those 87.5 calls, puts us right there at, what is that? 87.5 plus $5, going to put me at $93, $94 is about where our break even is. Did I do that math right? Calls 87.5. Oh, 2. So 93. Yeah. So 93 should be our break even to the upside. And that's at expiration when all of this, what we paid for it is almost worth zero. We need to be there in order to gain that, for that market gain dollar for dollar. Okay. But if this happened really quickly, we would see profitability sooner than later. So like I said, if we see this volatility coefficient go up, by 1% even, you can see that we are already in profitability. If it happened this day, the market didn't move, no theta decay happened, volatility expansion. That's why we want to pick low volatility, because when we look at the chart, we can see when volatility is really low down here, it starts expanding. It's actually on the uprise right now. It took a little dip, but we're starting to rise back up, maybe heading into earnings. And another thing with earnings, we can put this strategy on in and around earnings because we expect that volatility to expand. If you do that, though, I would highly suggest getting out before the release of that data, because volatility, as you can see, after that data crushes. Okay, and you might be able to get the move, but that volatility crush could make it not profitable, even though you get a big outpaced move with that volatility crushing down. Or it might not be as worth as much after the event than it was before the event, even though you got a directional move you were expecting because of all that volatility coming out. Does that make sense? I tried to say that a couple different ways so you guys would catch on to that. So the volatility, even though you might get your directional move, you might see that the day before it was worth more money than after the big move, only because of that volatility coming out. So make sure if you do this going into this event that you're just basically buying volatility and getting out of that strategy with the volatility expansion. All right. So target, I'm not too concerned about the earnings while I'm setting this up, other than knowing that they're coming up. I'm probably in that wheelhouse. And we paid that $5.50 for it. So when I look at this, shoot the trade in, I would say, you know what, I don't know where it's going to go because it's kind of consolidated, which is something I would look for in a trade like this. But it looks like it's ready to break out of this little range it's been in for a while. I don't know if it's going to break out to the upside or to the downside. So I'm going to do a strangle. And that would be coming up with my directional assumption, right? Then I'd look at the environment. All right, where's the implied volatility percent? It's below 50. That's good. All right, the trade window, the closest to expiration monthlies, is it inside of 10 cents wide for a stock under $100? No. So when it's inside of 10 cents wide, that's a green light. If it's outside of 10 cents wide, then, you know, you guys are going to have to call it a yellow light. Unless you've been trading options for a really long time and you're comfortable with wider markets, then I don't have a problem with you going in there. My rule of thumb for this is inside of $100 or less than $100 stock is 10 cents wide. That's to save the newer traders or the guys that are trading maybe for a year or less, a lot of anguish in getting into stocks that they have heard are an opportunity, and don't just give up too much edge getting in and out of these. All right. So buy the 30 to 35 delta on the call and the put when IV is lower. Yes, than 30, and close when the premium doubles. Yes. And buy longer than 57 days. Correct. You nailed it, Banu. Buy the 30 to 35 delta. Yep. IV percent lower than 30. I'm good with that, especially if you're a newer trader. I said for stocks lower than 50, but also as long as you expect volatility to expand, that's also another thing you could have if you've been trading options for a while and you're like, hey, I know about IV is going to expand. Then, you know, you might be able to bend one of my rules there then. And then buy longer than 57 days to expiration. Yes. Nailed it. Nailed it to a T, right? So that's it. That's pretty simple to set up, right? We're just looking for that 30. And these deltas don't have to be exactly 36 and 36 or 30 and 30. It's just, you know, closest to that 34-ish, 30 delta, okay? I usually will, if I'm looking between, like, you know, you're saying, oh, well, hey, Wolfman, 28 is closer to 30 than 36 is. Yeah, it is. But I also would rather roll it a little bit closer, pay a little bit more, increase my probabilities of success on this strategy by just finishing in the money by 1 penny. I'm increasing my probabilities of success 10 cents or 10% to the upside. I have a 10% higher probability with this one than this one, and almost a 20% probability higher that XYZ is going to trade 87.5 in the next 90 days than it is to trade 90. Okay? So that's why I would rather roll it closer. I'd rather come up and get kissed because I'm more likely to have, as soon as these start getting into the money, that's where you start seeing your payoff happen, right? Because the deltas increase, the gamma increases closer to at the money. So that's why we want to get a little bit closer. So we get paid more for every dollar for dollar move, all right? Because for every dollar XYZ moves higher, on this strike, I get paid 36 cents for every dollar. And on this strike, I only get paid 28 cents on that first dollar. So I'd rather get that extra bang for my buck. All right. And then we're going to exit on this one when it's a double or it's gone to or a fifth. When I say a double, I should be saying an increase by that 50%. So it would go from $5.47 to $7 or $8. All right. I don't mean a 100% increase. I meant a 50% increase in the premium when I said that. So it goes from $5.47. So did you get that, Bandu, also, or Banu, that the increase in premium? I think I said earlier a 100% increase in premium. We're looking for a 50%, so 1.50 is my target. All right. Okay. So you guys, we've added all of these new sections to the watch or to the membership, and each one of these 7 different categories has several different webinars within it. But this is what I talked about several times. So you can check off these after you've gone through these checklists and say, hey, I finished this particular course. All right. So you can go in there. That's all set up. We have also reorganized it and set up new categories, archived the different option workshops. So we've got it all in one place. So it's simple to use and a lot more organized. So take advantage of that. Check it out. Let us know. Get us your feedback on that. And, we need to have that feedback so we can make this a little bit better for you. And we're going to give this because we're doing that new setup. We want you guys all to check it out. We got a 1-month trial for $7. You guys should really be trading with this knowledge, you guys. I don't care how long you've been trading. The way I teach options is different than everybody else. So you need to be making sure you follow my rules to increase your probabilities of success. So take advantage of this, especially if you've enjoyed my webinar. You also get daily market commentaries. I talked about that. I talk about every single trade I put on, when I take them off, whether it's the good, the bad, and the ugly, all right? Whether it's the good, the ones I bang out and make money on right away, the ones that are bad, that I've lost money, and the ones that were kind of ugly, like the eBay trade where I'm having to stay mechanical and doing covered calls. I mean, we don't want to have to do that, but it is a necessity sometimes. So I go through how I trade all this stuff and following my rules. So it really reinstills my rules with you. All right. And the other workshops that we talked about, I also have other videos in here that are shorter, 15-minute videos on all of my webinars so that you don't have to watch the whole webinar, a month down the road after you've watched it and you were like, hey, what were those rules again? So I've done those in there. And you also get unlimited access to me. That's something I forgot to mention last time, I believe, is that you get, if you reach out to me with any questions, I have a no inbox policy, meaning I answer all the questions or at least read all my emails. Take advantage of that because I will reach out as soon as humanly possible to answer your questions. So that's also a benefit to the premium membership offers, that you can reach out to me anytime you want. And please reach out to us at 310-598-6677 or email us at trading@protraderstrategies.com. This link right here, if you're watching this on tape delay, you're going to have to pause it. But if you're watching this live, I've got it over there in the chat window. We've been going back and forth in the William, I see your question there. I'm going to get to you in a second. In the chat window, though, is a link to this premium membership trial offer for $7. I mean, you can't beat that. You'll be able to make up your money in that time. All right. So I just want to thank you guys. In later webinars, I'm going to be drilling down on different option components and how I trade those options. Trades I find, when and where I find them appropriate. Here's also that link again. Also, it's not a hot link. You're going to have to pause it, type it in, or just hit on that chat window and we'll get you set up. And thank you again for watching. 310-598-6677 or email us at trading@protraderstrategies.com. So take advantage of that because seriously, there's, and this says there's only I don't know, 50 some odd videos. There's hundreds of videos in there now, especially after we've reorganized these. There's even more than just this right here. These are some of the ones that we've reorganized now. So take advantage of that and jump on it for $7, you guys. You can't beat it, especially now that we're getting into earnings season. You guys should be watching that for just the earnings trades alone. All right. So William said, can you share the main discrepancies and difference in the weeklies versus the monthly strikes? The main discrepancies and differences in the weeklies to the monthlies in strikes. Well, usually these weeklies, for starters, are going to have a little bit less volume and open interest than the monthlies because most of the bigger traders will go there. There's not usually a huge discrepancy other than you'll find a little bit wider bid ask in these weeklies, all right? That would really be the only thing. There's less participation. They're going to be a little bit wider. I almost exclusively deal in the monthlies rather than the weeklies. But if you're used to trading in the weeklies, I would have no problem you implementing this strategy along with my rules in the weeklies. Does that answer your question? There's no real main discrepancy other than, people trying to nail the theta components or, gamma traders really like to be inside the weeklies because they want to, scalp that, those small moves. Okay. And the weeklies will a lot of times maybe even have the half strikes or tighter strike locations. But I don't even look at those, to be quite honest, very often. Great. All right. So like I said, take advantage of that, you guys. The premium membership offer with all those new videos in there and the new archives and everything else. So jump on that. All right. If there's no more questions, that's all I got for you guys. Other than if you can't take that, take it easy. Take it easy, guys. Thanks, JQ. Take care, guys. Yeah, the link's in the window, in the chat window, guys. So we've been going back and forth in the questions box. It's over there in the chat. Can you use this strategy for the Rut and Spx? Absolutely, Doug. If you have a large account, the SPX, if you have a smaller account for people, I would use SPY. If you are finding yourself trading SPY at 10 contracts or more, use SPX because SPX is 10 times bigger than SPY, guys. But yes, you can use that with any ETF, but remember, or index. You're probably throwing out there SPX is not an ETF, it's an index. But yes, actually SPX is an ETF, but the ETFs or indexes below IV % of 30. The reason why is because there's a lot of underlyings in those ETFs or indexes, and the volatility really gets kind of mellowed out. So we'll accept a little bit less in those. All right. All right, guys, take care. Thanks for showing up, and I'll see you guys next week. Or maybe tomorrow if you guys take advantage of the membership, and we'll talk in the daily market commentaries. Later.